90% of people using the RSI indicator for spotting divergences have incorrect settings. If you also want to learn how to use and configure this indicator correctly, stay with us until the end, because today I'm going to show you the RSI's weak point so that you won't fall into the trap of false divergences and can identify the most accurate divergences with RSI. Most people with trading experience are familiar with divergences and often use the RSI indicator to detect various divergences. However, you've probably experienced that this indicator works well in some areas and fails in others, leading to losses. But you should know that the problem isn't with the RSI indicator. It's the settings you're using. I'll teach you the settings that will give you the best results with this indicator. First, go to the TradingView website and select RSI from the Indicators section. 90% of people using this tool stick with its default settings, thinking that they are the most optimized settings. However, this is entirely wrong, and with these settings, your results will be inconsistent. In the Style section, uncheck the option for RSI-based MA. In the Input section, change the length from 14 to 60, set the source to OHLC4, change the type to SMMA, adjust the length further down to 3, and finally, change the BB value to 2. These are the most optimized settings for this indicator, but there's still more we need to do to identify the best zones for finding divergences. Add a horizontal line, set its value to 65, and color it red. Add another line, set its value to 60, and color it orange. Add a third line, set it to 40, and color it orange as well. Finally, add one more line, set it to 35, and color it green. Now we've established the range we need. Next, we need to look for divergences. In previous videos, I explained divergences, but I'll briefly recap here. For more in-depth training, watch those videos. When the price forms higher highs but the indicator shows lower highs, we have a bearish divergence, and we expect the price to move downward. Conversely, when the price forms lower lows but the indicator shows higher lows, we have a bullish divergence, indicating a potential reversal to the upside. Now, with the ranges we've drawn and the new RSI settings, if the indicator is between the red and orange lines, we look for bearish divergences. Similarly, if it's between the green and orange lines, we can enter positions for upward price movements when a divergence forms. Let's look at some examples. The price is forming higher highs, but when we check the indicator, we see lower highs. As shown, the indicator is between the red and orange zones, so we can enter a position based on this bearish divergence. For a more precise entry point, we can draw a small trend line and enter the position upon its breakout. Place the stop loss above the previous high and set the target at 1.5 to 2 times the stop loss. Here's another example. The price is forming lower lows in a downtrend. When we check the indicator, we first ensure it's between the green and orange lines. In this case, it has even dropped below the green line, indicating the price is oversold. We can either enter using candlestick patterns or wait for a trendline breakout to secure our target. These settings allow you to identify the most accurate divergences and avoid the risk of false divergences. But remember to thoroughly backtest this method on a demo account first to master it. Once you're proficient in these settings and divergences, it will be extremely difficult for you to incur losses. If you have any questions, ask them in the comments. Don't forget to subscribe to our channel because we're going to release some amazing videos for you. See you soon.